All right, let's get into it. Today, we're going way beyond just spotting shapes on a chart. I'm talking about learning to read the story the market is actually telling us. And we're going to do that by looking at some of the most powerful formations out there, triple candlestick patterns.
So let me ask you this. Are you tired of getting faked out by the market? You know that feeling, right? You see the perfect setup, you jump in, and then bam, it reverses on you. That classic whipsaw. Or maybe it's a breakout that just fizzles out. It's got to be one of the most frustrating things in trading. And trust me, you are not alone.
Well, what if the secret isn't some super complicated indicator? What if it's about learning to read the story the chart is telling you? Specifically, its three-candle story. See, these triple candlestick patterns, they give you a much more complete picture. Think of it like a little three-act play of market psychology, and understanding that play can seriously cut down on those annoying false signals.
Okay, so what are these candlesticks actually saying? Let's talk about the psychology of price action. Before we jump into the specific patterns, we have to remember what each and every candle actually is. It's not just a piece of data, right? It's a snapshot of a battle, a fight between the buyers and the sellers over a set period of time. A big old green body, that's pure optimism, strong buying pressure. A long red one, that's fear, that's aggressive selling.
So, a triple candlestick pattern, it basically takes that one-on-one battle and turns it into a short story. You get three candles in a row that literally show you how control is shifting, moving from one side to the other. And that's where the real power is. They reflect the market psychology, and that helps us see potential trend changes coming with a whole lot more confidence.
So you might be asking, why three candles? Why not just one or two? Well, it all comes down to a really important trade-off. We're choosing confirmation over speed. We're essentially letting the market do the hard work of filtering out the noise for us.
And this comparison here really breaks it down. Look, on one side, you've got single and double patterns. Yeah, they're fast. They give you a quick signal to jump in. But the downside? They are way more likely to get caught up in market noise and give you those fake outs we hate. Now on the other side, you have the triple patterns. The signal is slower, for sure. You're getting in a little bit later. But, and this is a big but, it comes with much stronger confirmation. You're seeing a real, developed shift in power. You're trading a little bit of speed for a much higher quality setup.
All right, let's dive into some of the core reversal patterns. We're going to read the battle for control and really focus on that three-part story each one is telling us.
Okay, check out the story of a morning star. It's a classic bullish reversal, and it's a perfect example of this three-act play. So Act 1, the downtrend continues. You get this big bearish candle showing the sellers are totally in charge. Act 2, the battle for control. The second candle is small, kind of indecisive. This is where sellers start to hesitate, they're losing their mojo. And then the grand finale, Act 3, the bulls win. A big, strong bullish candle closes, confirming that the buyers have just completely overwhelmed the sellers and taken over. It's a complete narrative of a power shift right there in three candles.
And look, this isn't just some nice-sounding theory. Thanks to the awesome research by Thomas Spolkowski, we know a lot of these patterns have pretty impressive track records. I mean, look at three white soldiers, 82% success rate, or three river bottom, even better at 85%. Now that data gives these patterns some serious credibility. But, and this is key, you always have to remember that success depends entirely on finding them in the right context.
So we can spot the patterns. Great, but that's not enough, is it? Now we need a framework to actually trade them. Let's build a simple, four-step plan to go from just seeing a pattern to potentially making a profit.
Okay, here's your four-step action plan. Super simple. Step 1, you identify the pattern, but in context. Location matters more than anything. Step 2, you wait for confirmation. Patience is everything here. Step 3, you plan your entry and, just as importantly, your stop loss. And finally, Step 4, you set a profit target. You've got to know where you're going. All right, let's break each of these down.
Step 1, context is everything. I cannot stress this enough. A perfect-looking pattern in a terrible location is a garbage setup, period. But when that same pattern shows up near a major support or resistance level, its reliability just skyrockets. If you're a swing trader, you should be living on the daily and 4-hour charts because they filter out so much junk. Think about it. A bullish pattern at support on a daily chart when the overall trend is up. That's an A+ setup. But a pattern just kind of floating around in the middle of nowhere? Forget it. That's noise.
All right, Step 2 is all about confirmation. And you know what the best kind of confirmation is? Volume.
Volume confirms institutional intent. Think of volume as the fuel in the rocket. A gorgeous pattern with no volume is like a rocket with an empty tank. It's not going anywhere, it tells you there's no real conviction, and more importantly, the big money, the institutions, they're not interested.
And this right here, this is exactly what you want to see. A huge spike in volume, especially on that third and final candle that completes the pattern. I'm not talking a little bump. I mean 2, maybe even 3 times the recent average volume. That is your signal that there is real money, real conviction pouring in behind this move. It just massively increases the odds that this thing is going to keep going.
Okay, so now for steps 3 and 4, the actual trade plan. Let's use a bullish example. Your entry trigger is simple. You enter after that third candle closes, confirming the pattern is complete, and hopefully it closed with that big volume spike we just talked about. Next, your stop loss. This is your safety net. You place it just below the absolute low of the entire 3-candle pattern. No guessing. That defines your risk right there. And for your profit target, the most logical place to look is the very next key resistance level. See? It's a simple mechanical plan, no emotion.
All right, time for a reality check. Because let's be honest, no pattern on Earth works 100% of the time. So let's talk about how to avoid those false signals and really manage your risk.
And this quote is so important. We have yet to see much quantified backtest of candlestick patterns. Practically all candlestick analysis is based on anecdotal evidence. It's a great reminder that while guys like Bukowski have done great work, a lot of this is still based on observation. It doesn't mean these patterns are useless, not at all. It just means you can't treat them like some kind of magic formula. They're a tool, and success comes from using that tool inside a disciplined system. So, how do we increase our edge? How do we stack the deck in our favor? Well, first, stick to higher time frames. The daily and 4-hour charts are your best friends for filtering out random noise. Second, always look for that volume confirmation. Third, be patient. Don't jump in before the pattern is even complete. Wait for that third candle to close. You can also combine these patterns with other tools, like an RSI showing an oversold condition, or a bounce off a key moving average. And finally, and maybe this is the most important one, be selective. You don't have to trade every pattern you see. Wait for the absolute best, highest probability setups where everything lines up perfectly.
Which brings me to my final point. Your edge is your discipline. Let's talk about where your real advantage in the market actually comes from.
Because here's the bottom line. Success in this game isn't about finding some secret pattern nobody else knows about. It's about executing a disciplined process with rock-solid consistency. The patterns, they're just a tool in your toolbox. Your real, lasting edge comes from applying that whole framework we talked about: context, confirmation, and risk management. Trade after trade, day after day.
So I want to leave you with one final question. Are you just spotting patterns, or are you finally reading the story? Are you going to keep looking at charts as just a bunch of shapes, or are you ready to start reading the incredible story of market psychology that's playing out right in front of you? Because really, that choice, it can make all the difference.